So let me ask you a very strange question. Imagine you own just 5% of a company. You're not the founder and you're not even the CEO. You don't even work there. Yet, one day the CEO wakes up and find himself answering your letters. The board start discussing your demands and the media begins covering your opinions. But how is that even possible? See, a small spark can create a great fire, and in corporate, that spark is the billionaire activist investors. And today, we are going to explore how and why exactly these investors start corporate wars and why CEOs fear them, and why owning just a tiny piece of a company can sometimes give you enormous influence, right? So, before we have to understand anything that sounds weird, I would suggest you to understand what is the underlying problem behind it, right? Because in finance, the weird phenomena exist because of certain problems. So, before understanding what activist investors are, we have to understand why do they exist in the first place, right? So, the core problem is around the difference between the private company and the public company. See, what happens in the private company is actually the owner is the manager, right? So owner is basically whoever is gaining from whatever is happening in the company, and managers are basically who are making all the decisions. So whatever decisions the owner take, it will either lead to a loss or a profit. The owner itself will bear the loss or the profit, so he takes decisions accordingly. But that is quite different in public companies. What happens in public companies is owners are basically the shareholders who are sitting in the market, and managers are basically who are taking all the decisions. The executives are sitting in a corporate office, right? And this is basically what is creating a agency problem. And due to the agency problem, what is happening, the managers are not always acting in the shareholders best interest. Now, how are the interest of the managers and the shareholders different? See, according to the shareholder, if the company is generating a very strong cash flow, the investors should get dividend, they should get, or maybe the company should buy back their own shares, right? So they believe that the capital should return to the owners. But according to managers, if they have a sufficient and a good healthy cash flow and excessive cash, they should acquire more companies, right? So that their empire could actually expand in size, right? So for the management, basically building an empire is much more important and greater than the shareholder returns. So the problem is not a fight between the good people versus bad people, it is actually incentives versus incentives only. On one side we have the shareholders incentives, and on the other side we have the management's incentive, right? So finance, always in finance we talk about how to make money, right? It's the finance. See, by definition finance is making money through smart decisions, right? So we have identified the problem, now we have to identify how activists are actually trying to make money, right? For activists, they believe one thing, they want to increase the value, right? And if you think that activists actually just want to run the company, this is totally a myth. They are just there to exploit the gap between the potential outcome and the reality. See, if the current share price of that particular company is 100 rupees, what they believe are due to mismanaged capital allocation, asset allocation, or the misaligned management's decision, what is happening? The company is not yet reached its potential value, right? Because the decisions, the underlying decisions are mismanaged and misaligned, right? They believe that if the company is able to reach its potential, the share price would be 180, hence the intrinsic value should be 180 rupees, right? So what they do is basically they don't see, they are not believing or saying that the company is broken, they are just saying that the company could do better, right? And that's how they make money. So why? Right? Why the difference between the value? So they believe that the capital could be poorly allocated, right? There might be cash that is wasted on bad projects, right? The company could have acquired companies that aren't as fruitful as they first thought should be, right? Maybe the costs are too excessive in terms of the overheads being too bloated, right? Or they could be inefficiently handled, right? There could be a lot of unused assets which are locked away, right? Which are basically hindering the growth. The governance, the accountability to the owners could be weak, right? And the strategy could be misaligned, right? So what activists actually do, right? So first, they buy stake in what, right? This is not actually the first step, but they their first step is actually buying stake in meaningful quantity, that is 5% or plus, right? But in which company? For that, they first do a research. They conduct detailed data analysis and research, and with whatever they come out, see, they find loopholes, they find hidden gaps, right? And then they buy stake in that particular company with a meaningful share, and then they send out letters, they contact the media, and with investors presentation they come up with a public campaign. And with that public campaign, they actually apply pressure to whom? To the management of that particular company, right? And then the management transfers the pressure to the board, and the board ultimately leads to the transferring the pressure to the shareholders, which eventually help in making the decision, right? And in this process, if whatever research suggested were actually true and scalable, the value would be created. And when the value is created, actually the activists win, right? So let's take a look at it mathematically. Let's say we found out a company, and the company is currently worth 10,000 crores. You do a deep research about that particular company, right? After doing a deep research on that particular company, you figured out that no, 10,000 crore is too less for that company's value. The ideal value of that particular company should be 1500 crore, right? So you buy a first you do is you buy a minority stake, that is 5%. Let's say you did a 500 crore investment in that particular company. Now you run the public campaign, you apply pressure, and you create the value, and ultimately you are able to make the company reach to a valuation of 15,000 crore, right? So basically you created a 50% in value, right? You initially invested 500 crore, and now you are having a gain of 250 crore. This is your profit, and that's how the activist investors are actually making money, right? But see, theory is always much more simpler than the reality. In theory, we are talking in a way that whenever there's a bad company, investors are activist investors are able to identify it. What they do is just they randomly buy stakes in that company, they force the management to make some decisions, the value eventually improves and everybody wins. But this is far away from the reality, right? In reality, things are quite messed up or maybe twisted, right? See, when we're talking about a corporate battlefield here, right? So there are multiple stakeholders who are involved, right? And because there are so many multiple stakeholders that are being involved, it creates resistance and friction, right? It is hard to enter into, and this is the reason why not everyone is an activist. See, first of all, the first and the most important step that I talked about was research and analysis. This thing has to be brutally to the core, to the ground investigation, and often it tends to be very expensive. And whatever process that we are talking about here, it is not something of a short duration. It could take years, it could take months, not months but years, right? And when we're talking about such a big company, okay, so first of all, if you have the capacity to buy in stake worth 500 crores, right? So it's not the same for the it's the same for the management as well, right? They also have and hold certain powers, right? They won't be just sitting down and listening to you, right? So management resistance is also there, and it could also invite a lot of legal fights as well. And this whole entire process is kind of involves high reputation and regulatory risk, right? So what and how activists are able to create these particular value is deeply associated with what and how the asset allocation or the asset efficiency is there in that particular business. But how do they do that is basically they could set target for the company to buy back shares, right? If the company is holding on to excess cash, they could make the company do a share buyback. They could also focus and make the company cut costing on the bloated overheads. They could make sure that the assets that are essentially non-core and are not used for their business and just locking in value could be and should be sold, right? They could also implement board changes, right? They could request replacement of directors who they think are not thinking in the right direction, maybe. They could also enforce spin-offs, right? Spin-off is basically, let's say you're talking about a conglomerate, right? The conglomerates, let's say there's a conglomerate called Bye, right? Now it is operating a both car and a power company, right? Now if we are considering them as equal, right? So this comes under a same company, right? This is a conglomerate. These two businesses are totally different, right? So what happens is spin-off. The car is registered as a separate business and the power is registered as a separate business, right? So it is basically separating the business from the parent company, right? This is called a spin-off, right? It could also enforce management change as well, right? Now we have to understand about the conglomerate discount. So let's talk about this particular example, right? So this car and power, right? Let's say it is individually so together they are worth 100 crores. Why? Because okay, now when we are able to separate these two businesses, let's say we have unlocked the total value of 600 for the car, let's say, and 700 for the power, right? And now it is worth 1300 euro. But why and what creates this particular situation? See, when we are looking at a conglomerate, it is very difficult to identify the ratios behind it. In what ratios is revenue coming from what sector, right? Where are the costs? What sector is acquiring and getting and wanting a lot of cost, like? So it is much more difficult to actually break the complex structure to actually reveal the truth about the companies. So this is basically what happens in scenarios like this. We are able to analyze the true potential of the car sector and the power sector individually, and this could lead to increase in the value, hence the spin-off, right? So our first case study actually takes us back to 2013. So during that time, Apple was basically printing money, but that actually created a very unique problem. See, what happens when a company accumulates enormous cash reserves, right? This is a problem, right? What to do with that? And at that time, Apple actually had 150 billion dollars in cash, right? So legendary investor Carl Icahn basically looked at the mountain of money, and to him idle cash was basically something that was destroying money, right? Destroying value or maybe destroying money. So basically he started a fight, but he had nothing to do with the iPhones. He never was focused on changing how the iPhones are made, right? He only wanted a better capital allocation, right? So he aggressively pushed for the 150 plus billion dollars to make sure that there are stock buybacks. So he used public letters and massive media pressure to basically force the board's hand, right? Eventually, the board caved and agreed to significantly increase the capital return to the shareholders. And somehow, this particular fight was not at all about the operation as such, but about capital allocation, right? Now let's talk something about the operation side as well. So Bill Ackman capital story from Chipotle, sorry, Bill Ackman and Chipotle story from 2016 to 2018 was basically a huge bet on operational recovery. So Chipotle was actually in a very was in the middle of a crisis mode, right? So Ackman basically realized a massive disconnect between the brand and its current reality. See, on one hand, what was happening? We had a strong business, right? It was a beloved brand, right? It had a loyal customer base, and the business itself had a massive underlying potential to grow. But on the other hand, what was happening? We had a fundamentally weak situation. The horrific food safety scandals, the poor management, and basically the stock prices were crashing. So Ackman bought a massive stake in the company and pushed for the board seats and operational fixes. He basically wanted to sell parts of the business and fix the kitchen. And you know what? It actually worked. The stock actually was able to recover, and that too dramatically, right? So activism can also be a bet on recovery as well. It's not just about breaking things apart, right? Now we have to understand the middle ground as well, right? Now if you're talking about activists that they are here to help everyone, or we are talking in the opposite direction and saying that activists only destroy companies, we are actually oversimplifying everything, right? For everything we have criticisms as well as the supporters, right? So what critics actually say about this activism is basically what they are doing is they are focusing on the short term goals only, and the long term health could be affected by those decisions of the activist investors, right? What they are basically trying to aggressively cut costs, which eventually on the ground level hurts the employees, right? And because of their so much public pressure, they could actually create a lot of uncertainty and distraction, right? And sometimes it is actually driven by a lot of ego, right? But what supporters say for this is, at the ground level, it is actually helping in improving governance and accountability, which is very very important aspect of a business, right? It is basically enforcing efficient capital allocation. This is a very good thing for the business as well. It can actually help unlock trapped value, which was somewhere hidden between the bad decisions or misaligned strategies, right? And it could also act as a check on the entrenched management as well, right? Maybe checking a governance on the management itself. So what is happening through the micro to the macro level? One investor is basically challenging the management of a single particular company, right? With and that particular company is basically understanding what that particular person has to say with a lot of pressure, of course, and they change their strategy, their governance, and their structure. But at the macro level, what is happening? The overall accountability and efficiency is increasing. So the capital markets are actually benefiting from it, right? So just to conclude, right, coming back to the first question that was asked, why activist investors actually exist, right? The problem statement was the owners, which are the basically the shareholders, are separated from actually controlling the company, right? This is the problem statement. So managers, because of that, managers have different incentives and the shareholders have different incentives. So it's a fight between the incentives only, right? And this particular fight is actually creating a value gap in the company, right? So what activists do is they basically spot the gap in the company and buy in, right? And they apply pressure for a change, and that's how they take advantage of that value gap and fill that gap, right? So activist investors exist because ownership and control are separated in the modern corporation. They are not there to create any problem, they are just there to exploit the gap between potential and the reality, right? Sometimes they are able to improve the companies, and sometimes they fail, and also sometimes they just create controversies. But every one of them start with the same belief, that is to exploit the gap, right? So the core belief behind them is the company could be worth more than it is currently worth today, and that particular single belief is basically driving billions of dollars across the economy, making corporate battlefields, and is responsible for one of the most biggest transformation in the business history, right? So the next time you hear about an activist who has bought 5% of a company, Don't focus on that number 5%. Ask this question: why is this company, and what is this company doing wrong? Why do you have to ask this question? Because sometimes they could be wrong, but sometimes they could be right as well, right? But activist investors are basically trying to look for the gap between the potential and the reality only and only. And that gap is some of the reason for some of the biggest battles in capitalism. So if you enjoy deep dives in finance and hidden mechanisms, please do subscribe, because most interesting stories in finance are rarely about money, but they are about the human psychology and behavior. Thank you so much.